In this video, we will discuss about the Income Tax Act. Income tax as a concept has been present in India for many years. But James Wilson, who became India's first finance member, introduced the first modern Income Tax Act in 1860. It was only for the good of his subjects that he collected taxes from them, just as the sun draws moisture from the earth to give it back 1,000-fold, wrote Kalidas in his epic poem Raghuvansh. What is income tax? In India, income tax is a tax you pay to the government based on your income and profit in case of companies. The government uses this tax money for various purposes, including public services, infrastructure development, defense spending, and subsidies, among other options. If you earn income beyond a certain limit, it is mandatory to pay income tax every year. Now, Income Tax Act of 1961 is a comprehensive statute that focuses on different rules and regulations that govern taxation in the country. It provides for levying, administering, collecting, and recovering income tax for the Indian government, and it was enacted in the year of 1961. This act contains a total of 23 chapters and 298 sections, according to the official website of Income Tax Department of India. These different sections deal with various aspects of taxation in India. The various heads for which you have to pay income tax includes salary, income from house property, capital gains, profit and gains from business or profession, income from other sources. Every year, Indian government presents a finance budget during the month of February, and the budget brings in various amendments to the Income Tax Act. This includes changes in tax slabs wherever applicable. For example, the finance minister announced that the tax rate for individuals in the lowest tax bracket of rupees 2.5 lakh to 5 lakh would be cut from 10% to 5% in financial year 2017. Similarly, tax on long-term capital gains was reintroduced during the financial year 2018 budget. As a result, all gains greater than rupees 1 lakh from shares and equity mutual funds held longer than 1 year is now eligible for LTCG tax, which is long-term capital gains tax at 10%. Here, as you can see on the screen, this is website of Government of India's Income Tax Department, and here it is mentioned that people who earn up to 2,50,000 rupees per year, they don't have to pay any tax. But soon after the income rises more than 2,50,000 up till 5 lakh, it is 5% in the assessment year 2022 to 23 and was same in 2021 to 22. And further, you can see the several other taxes which are being imposed. This was according to individuals, next is for senior citizens, and next comes super senior citizens. Senior citizens are those whose age is 60 years and above, and super senior citizens are those whose age is 80 years and above. So you may pause the video and have a glance at the different taxes which are being imposed on different people. Now we will move further to discuss who are income taxpayers in India. Every Indian citizen has to pay income tax if their annual income is above rupees 2.5 lakh, as I already showed you in the previous slide. And in addition to individuals, entities such as Hindu undivided family, body of individuals, corporate firms, companies, artificial juridical persons, local authorities, and association of persons also pay income tax. According to data, 6.84 crore people filed income tax returns during financial year 2017 to 18, and this resulted in net direct tax collection of rupees 9.95 lakh crore for the year. This was 17.1% higher than the collections for the previous year, and this data is according to Central Board of Direct Taxes. Over the last 6 decades, the economy of India has become more integrated, globalized, liberalized, and new models of business have arisen. Therefore, the Act needs to be redrafted and be made accommodative of the needs of the present as well as of the next few decades. Now, there are several challenges in the direct tax system which is prevalent in India. Firstly, the tax rate is quite high for both individuals as well as for the corporates. Next comes the tax dispute. And in Indian taxation system there has been a huge number of tax litigations, which makes the whole tax dispute resolving mechanism unviable, and this is a major cause of concern in ease of doing business and enforcing contracts. Lastly, exemptions. There are a plethora of exemptions in direct tax code, which makes the filing process more complex and it reduces the effective tax rate. And let me tell you that recently the income tax department started the faceless assessment scheme on a pilot basis. Now, what is this faceless assessment? It is a randomized and anonymized assessment aims to eliminate physical interface between taxpayer and tax assessees. And in the system, one need not appear before a tax officer and there is no physical movement of papers or person. It will reduce a lot of pressure and address issues faced by tax administration during an assessment. And the need is to make the faceless or e-assessment widespread and mandatory. As in contemporary times, the use of technology can help a lot in easing the hectic ways of filling the tax papers.